All right, Lemonade popped 27% yesterday after releasing earnings. We've been screaming into the abyss about the company for a while now, but let's talk about what we learned yesterday and why we think this might actually just be the beginning. So what we're going to do in this video is walk through their actual letter, as well as touch on a couple of the points that came up on the call, and then give an update to our overall thesis. So this is the letter that came out on Wednesday after the close. And what you can see here is just a continuation of the trends that we've been talking about for a long time. So the overall thesis for Lemonade is just that as they continue to scale up their in-force premium, which is essentially how much insurance they're underwriting, and scale up, that will in turn scale up their revenue. And what they're doing is really keeping fixed costs roughly the same. And so you just continue to scale up revenue and you get tremendous operating leverage. So what you see here is just a continuation of that trend. You can see these are the year over year trends, and in-force premium up quite a bit. And then on the other side, you've got loss ratio coming down. This was actually one of the key, I would say, bear theses, was that Lemonade doesn't actually have a structural advantage with their AI, and their underwriting is actually very poor. And so when they had these loss ratios of around 94%, or even in the 80s a year ago, that was, I think, a real strength of the bear thesis. And just as a quick aside, for those of you who might not be as familiar with the insurance side of the business, loss ratio is essentially just the ratio of your payouts to how much insurance premium you're collecting. So if that ratio was 100%, for example, that means that for every dollar of premium you're bringing in, you're paying out a dollar in claims. So you want that to be somewhere in the 70-75% range. Lemonade has said that their target is 75%, but they might be getting lower than that in the long term. So that could be some upside as well. But I think what you're seeing with this Q3 result is not necessarily any one particular stat that's kind of jumping off the page and screaming that it was just a total beat in the way that you saw Root, for example. Root's another insurance company that absolutely smashed earnings out of the park. And it was a huge surprise since the stock was up, I think, over 150% at one point yesterday. It's since come back down a bit. But with Lemonade, what you see is just kind of consistent quarter-to-quarter growth, and they're executing on this long-term strategy that they laid out many years ago. So these numbers, I think, are just a good continuation on the path that they've been on for a while now. And what you can see also is that their EBITDA losses are coming down. Let's keep going through here. The one number that I think did surprise pretty much everybody was a net cash flow of $48 million. I was expecting roughly neutral, slightly positive net cash flow, but to generate 48 million was just a bit of a wow factor. One other, I think, bear thesis that's been out there for quite a while is that Lemonade is actually financing their customer growth by what they call the synthetic agents program. And essentially what that is just borrowing some money from General Catalyst, which is a company we've actually had on our channel to discuss what they're doing with Lemonade and with other companies. I think it's actually a really great business model. But the naysayers out there are just saying, okay, well, you're financing your customer acquisition, you're paying a bunch of interest on that, and then you're branding it something fancy by calling it synthetic agents rather than debt. What we saw in Q3 was that they actually financed only a net of about $23 million from General Catalyst to fund their customer acquisition strategy. And so they generated $48 million, which means that even if you hadn't had this financing, you still would have been significantly cash flow positive. So this was, I think, just a very strong rebuttal to those claims. And so a lot of the bear thesis that we've seen to date has been, okay, they're just consistently losing money, which is true if you're looking at GAAP profitability, but it's not true on cash flow. And I think as an investor, you should be way more focused on cash flow than profitability or earnings per share. Not that earnings per share doesn't matter. If you're concerned about a company potentially going bankrupt, cash flow is the thing to watch. And the fact that Lemonade is now generating so much cash flow, and they're guiding essentially to continue that into 2025 and beyond, I think you're essentially de-risking the bankruptcy risk. And so this is reminding me of where Tesla was in maybe 2017, 2018, something like that, where the bear thesis was, oh, Tesla's just burning through cash. They're not profitable and they're going to go bankrupt. Well, now Lemonade has, I think, definitively turned the corner where they are cash flow positive, and the glide path to earnings per share, like GAAP profitability, is very clear as well. So you can see here, this is the trailing 12-month gross loss ratio over time. And so you can see this is just continuing to trend in exactly the right direction. And so as you continue to scale up the business, you're getting the revenue bigger. Meanwhile, your gross margin is really expanding because you're getting better at underwriting and your loss ratios are just getting better. The operating leverage that this model is generating is really staggering. And it's something that we've essentially been modeling out the business to run almost exactly as it has. And so our conviction in our thesis is really strengthening right now. And so just one stat that kind of jumps off the page here is if you look at the compound annual growth rate of the in-force premium, that's been growing at 21% per year, whereas operating expenses have only been growing at 6%. So that's the kind of operating leverage that we really like. And the thing that I think is even misleading about that number is that a lot of the growth in operating expenses has been to fund customer acquisition. So they're really plowing a lot of their increase in revenue and increase in cash flow just back into the business by acquiring more customers. And so if you exclude growth spend, what you can see is actually that the operating expenses are unchanged for 2 years. Meanwhile, your revenue is just continuing to grow. And we've modeled out their customer acquisition in great detail. And that's a very positive NPV spend that they're doing. And so we really love the business model. And you can see this in a lot more clarity here. So, this is your in-force premium per head count. So what they've done is that they've actually kept head count roughly the same. They've had some employees just kind of try it out naturally, and they're just not replacing them. Meanwhile, in-force premiums continue to grow. What you're seeing is that you've got $30,000, $731,000 per employee in in-force premium, which is a really strong metric. And there's every reason to think that this trend is going to continue. You can see here the same thing, but comparing the OpEx, excluding the growth and the marketing spend. And you see the exact same trend here. And so what we've been screaming for a while now is just watch where these trends continue. If you continue to grow in-force premium, which they're doing with great unit economics, and you continue to keep operating expenses flat, it's only a matter of time before the company gets, adjusted EBITDA profitable and then GAAP profitable. And one thing we're going to get to in another video is exactly how good that's going to look. So I spent a lot of my day yesterday buried in a spreadsheet, and what I found was the modeling that we were doing, suggesting that this company is a buy, had to be revised upwards in order to account for their reiteration that they're going to be adjusted EBITDA positive in 2026. This has a lot of implications about just how fast they're going to grow on their auto side of the business, which we'll touch on here, but we'll do a subsequent video going into that in a lot more detail. So one of the things the company is really focusing on right now is rolling out their car business. Let's take a look at some new disclosures that they included in this quarter for the first time and talk about why we think that this is actually going to be a game changer. That's a bit of an overused term, but we really do think that this shift that they're about to roll out is going to fundamentally change the company. So previously, the company had not disclosed a breakout of their premiums by product line. They've given some hints of that in the past, but here they provided this insurance supplement for the first time, which broke out their premiums by policy type. So this is homeowners, condo, and renters insurance all kind of lumped together, but then pet and car also included in here. What you can see most notably is the premium per customer on their car product is $1,750. Meanwhile, the company's total premium per customer is only $384. So you've got a very significant opportunity to increase the average premium per customer if you mix shift a little bit away from pet and renters towards the car, which is your highest premium product that you're offering. And this is exactly, in fact, what the company says that they're going to do. So the company acquired Metro Mile a couple of years ago. Maybe it was, I think the transaction closed a little over a year ago, actually. What we've seen since then is that they haven't really pushed it at all. In fact, if you look at their premium this is Q3 of 2023, they had $114 million of premium. Right now, they only have $117 million. So they haven't pushed this product at all. You might ask, okay, well, why? And the reason is that the loss ratio has been quite poor. So when they actually acquired the business from Metro Mile, they had a loss ratio of over 100%, which means that for every dollar of premium you're bringing in, you were spending over $1 in paying out claims. A lot of this had to do with the inflationary environment. A lot of this had to do with the fact that rate increases, particularly in California, were not being rolled out. And then some of it was just trying to get the underwriting up to speed. They are now at this point where it is at least profitable. It was at 92%. They've still got a ways to go to get this to the point where it's in their kind of target 75-ish% range. What we're hearing from management, both in conversations that we've had with them and what they're saying publicly, is that they are very confident in this product and are going to be aggressively rolling it out in 2025. So if they are able to do that and are successful in cross-selling this to their existing customers, what you could have is a very steep increase in the average premium per customer, just as you get more of these customers paying the roughly $1,700 per customer rather than the 384 that they're paying today. And they could potentially acquire a lot of these customers for very cheap. So as an example, right now, I'm a homeowner's policy holder for Lemonade in Michigan, but they don't offer auto insurance in Michigan. There are most of the geographies actually, they don't actually offer the auto insurance. They were really waiting to get their flywheel up and running and make sure that they had confidence in their loss ratios that they'd be able to achieve and make sure that their AI that they're using to price this insurance is actually pricing it appropriately. They're at this point now where they feel very confident in the product that they have, and they are intending to lean on this very heavily next year. So what we're expecting is that they will start with some very low-hanging fruit, basically saying existing policyholders that have expressed an interest, you can basically send an email to them and say, hey, do you want to include car insurance? And some portion of those will naturally just opt to go for the auto insurance policy. And that will have a very low customer acquisition cost and drive up the premium per customer in a pretty meaningful way. We'll do a separate video where we model out exactly how significant this could be, but I think the implications for how it's going to transform the business are not widely appreciated. So this just gives you an idea of how far they have come and how the thesis is essentially right on track. As a reminder, I think that the two biggest bear points were, okay, your AI is not actually that good as evidenced by the loss ratio, but what we're seeing is that that thesis is basically dead. Their loss ratio is exactly where they want it to be, despite some pretty significant hurricanes. There was a question about Hurricane Milton and Helene and what impact did that have on Q3 and might it have in Q4? And they basically said it's very minimal. They've been de-risking the home side of the business for a while, and they're continuing on that path. And it sounds like they've done that quite successfully. So we're kind of minimizing the catastrophic risk that Lemonade had some exposure to, and getting to a more kind of normalized level of risk where it's just a lot more predictable quarter over quarter. So we're very bullish about what's going to happen with auto insurance, the car side of the business in the next year plus. But one of the things that was a surprise actually was that they are moving away from the homeowners insurance a bit, not renters, and renters is kind of mixed in with homeowners here. One of the things that I got a chance to ask on the earnings call was what the plan was for homeowners insurance in the long run. My assumption had been essentially that they would focus on auto right now and really try to roll out that part of the business and then roll out homeowners a little bit more aggressively in the future. What they said on the call, though, in response to that question was that they didn't feel that they had a competitive advantage, which was a bit of a surprise to me in the homeowners market. So really the plan right now is to continue to offer it where it makes sense, but not really rely on that as a huge market for growth. The downside for that is that maybe the growth in, call it 2027, 2028 and beyond might not be as strong on the homeowner side, at least, as some people might have been expecting on the bull side. At the same time, I think people are significantly underestimating what's going to happen in the car insurance side of the business, especially in the short term. We'll go into the implications of that in another video where we go into the modeling in more detail. The very exciting thing right now is what's happening on car. The company did guide to be adjusted EBITDA positive in 2026. And frankly, I think a lot of people are incredulous at that claim. There was one of the analysts on the call basically was asking them, how are you going to do that? Because it's honestly hard to get your financial model to make that work unless there is a significant increase in core metrics in the next 2 years. And so I actually had to go back to my own model and really make some significant adjustments. And what I found was when I did that to get them to adjusted EBITDA profitability in 2026, the valuation I was coming up with shot up quite significantly. The year where they hit earnings per share profitability also moved up by, I think it was about 6 quarters. So very meaningful increases in the company's core metrics. And this potentially, if that case is true, where they are adjusted EBITDA profitable in or positive in 2026, I think the implication is that the company is going to surprise very significantly on all their key metrics next year. So we'll walk through that in a subsequent video and all the implications of that, but I'll just leave you with a couple thoughts. So one, we were already bullish on the company. We thought it was undervalued by at a minimum 3 times, kind of our more conservative case, and potentially by more like 5 or 6 times. So while this 27% move that we saw yesterday was very exciting. That's why we say it could just be the beginning. Coupled with the fact that there is over 30% short interest in the stock, that leaves the potential for a very significant short squeeze. The company had 16 million shares shorted, and the volume yesterday was very high. I think it was about 8 million shares. But despite that, I mean, even if you assumed all that was short covering, which there's no way it was, there's still a significant amount of short interest out there. So we're not invested in the stock because of short interest or the potential of a short squeeze, but it does add this kindling to the fire that if the company does get revalued in the way that we think it deserves to, just based on the fundamentals, it could have a very rapid, very vicious re-rating. So not investment advice, just wanted to share our thoughts. We're obviously very bullish. We do own it for clients and for ourselves. You can see our website for all our disclosures, but this is a company we're very excited about. We think they're doing some really great things, and they're hosting an investment day in a couple of weeks at their offices in New York that we will be attending, and we'll give you a summary of that after it happens as well. So thanks so much for watching, and bye for now.
Bye.